The slide in the equity markets that we saw at the beginning of the first full week of February 2018, we are now taking a step back to ask the question whether this is the beginning of something more serious on the downside, or is it an opportunity to buy back into the long trade for these equity indices. Ron William joins us now from RW Advisory. Ron, welcome.
Hi there.
We've spoken a lot recently about some of the market moves that we've had, including Bitcoin, of course, and you're going to refer to this, I know, in your chat today. But this trade that we've been presented with at the beginning of this, as I say, first full week of February. Explain what it reminds us about the rally that we've seen and where you think the trade's likely to come out of this.
Well, as we've been saying for some time in previous interviews, stay long in existing trends, but be ready to exit at short notice. And that's exactly what happened in the first week of February. We were looking for a potential sizable setback in the market, primarily because it's been long overdue. But having said that, at the moment, we've had a big rebound, as we've seen in our first chart, from those very oversold conditions. Let's just take a step back and just keep in mind it's a 10% correction on the S&P 500 and also most Western equity market proxies. That's the biggest drop we've seen since 2011. Having said that, once we unwound the record overbought levels, we are now short-term oversold. We need to break above 2740 and 2794, which is the 20-day moving average, so the monthly moving average, to revive the bullish momentum in this market.
Okay, let's take a look at the second chart and explain more about what's happening.
Yes, well, the second chart, I think, helps maybe answer the question that we're thinking of in terms of what this means for the big picture. And so there's one main chart here, but two chart inserts. The main chart is the S&P 500 monthly candlestick during its 2009 cyclical bull market. And what it shows is it's been trading within a predictable trend channel. The ceiling of that channel is roughly around 2740. We popped above that, so that was giving a very important statistical overbought signal. That could have been bullish, but of course we had the reversal thereafter, the following month, the month of Feb, after we had a very strong blow-off January. The happiest new year since 1999. If you look at the price move on the S&P 500, that is the strongest in a very long time. But right here and now, this is looking as a rolling fifth wave of the Elliott wave model. So a final top is still in place, but the cycles are suggesting that will potentially happen in the second half of 2019. Having said that, we could still have setbacks between now and then. It's just too close to call at the moment. Now, one thing that's important in terms of the chart inserts, just to mention, is that one of the reasons why we had a strong record happy new year in terms of equity market performance is also because we had record earnings revisions. If you just see the top chart insert there, which signaled this natural behavior of fear of missing out. A lot of people that were bearish last year flipped from bearish to bullish in their earnings estimates because last year was one of the strongest years in many. And then lastly, chart B at the bottom there, just showing that we had the longest time without a 5% correction in 90 years. So we really are making history as we speak.
Okay, let's take a look at chart number 3 to give us some more explanation as to where we go.
Yes, well, essentially what we have seen is a big rotation from greed to fear. Now, it is a short-term rotation for now. We don't know how long it will last, but I thought it would be good to bring everyone's minds back to late December of last year, when Bitcoin, arguably the strongest greed trade to man, signaled a top. We spoke about that in a recent interview, and then actually triggered a 70% crash, which is now holding at its 200-day moving average. We can follow up in future and talk about potential support levels thereafter. But that was definitely a great greed proxy. And of course, the rotation into fear is the big spike, the one-day move up, plus 116%, the biggest move we've seen on record. This is now looking short-term overbought, in line with prior spikes in the VIX, and it's nothing compared to the really big shocks in the market like the likes of 2008, the global financial crisis.
Okay, so on this chart, the bottom VIX index that you've put up there, you were expecting that spike that you got there with the top box, the top orange box, to revert to the mean. Where is the mean?
Yes, the mean according to the probability distribution which I use on this chart.
That's the blue shaded area on the left-hand side, yes?
Yes, and that basically shows that the mean is roughly around 20 according to that study. Now, it could mean that the new normal volatility band for the VIX will be from 20 upwards. So there'll be a new regime for the market. Certainly, if you look before that, we had a 3-year compression in volatility, which led to the breakout. And anyone who was short volatility, and there were record short volatility trades last year, made a lot of money, but that trade is now dead. So we are in the new normal. The floor in the market is likely to be around 20, not at the historic lows that we have previously seen.
Yeah, okay. Your last chart, you give us some individual stocks to follow, and I think if we bring up the chart, we can see clearly that this is all really about the tech stocks. And I know the tech stocks have been credited with helping the S&P 500 and the Dow up to these record highs in a greater proportion than some of the other sectors.
Yes, well, I mean, I've long said that the market has been skating on thin ice, and the best way to actually see the cracks in the ice is to look at the stock level, and the FANG stocks are the greatest weighting in the stock market. So if we look at the likes of Facebook, Apple, Amazon, Netflix, and Google, or Alphabet, we can see that the year-to-date price performance, so January into the first week or so of February, they have dropped from the top, and actually that drop has been led by Apple. You can see there the red line at the far bottom showing that Apple has actually fallen by 10% and is actually in the testing or recently broken its long-term 200-day moving average at the chart in the lower corner there. What's important on the flip side, actually, in terms of stocks within the FANG complex which have the greatest mean reversion risk, Netflix is actually looking like the one that could have further to go if we get further setbacks in the market. Otherwise, we need to look for support levels on these stocks to look for a revival in the overall index.
If we do see a mean reversal down to that 200-day moving average, which is presumably your target here on Netflix, you got that at 180.
Yes.
That's quite a sizable drop.
Yes, indeed, and that's partly because Netflix has just done phenomenally well in the last 3 months, whereas Apple actually topped out late last year, as early as October. So it has been looking mean reversionary for some time. It just took a strongest tumble in this latest setback.
Yeah. Okay. So let's regroup and bring everything together. So your message is wait for further indications, but you're ultimately bullish on equities and you want to go short volatility.
Yes, looking to basically remain with the existing trend. I think we've learned that over the last few years is not to call the top too early. This market has been resilient. We climbed a mega wall of worry last year, and so that is a positive for the market. But volatility is now back. And for that reason, we must be aware of risk management and just being that much more precarious for potential risks out there.
Ron, thanks so much indeed for joining us. We've got to leave it there. That's Ron William from RW Advisory. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.